March 2000. A 28-year-old founder named Marcus sat in his San Francisco office at 2 a.m. His company was worth $40 million on paper. He had 47 employees, a beautiful office, investors lining up at his door. By March 2001, exactly 1 year later, his company was gone. His employees were gone. His savings were gone. And here is what keeps me up at night. Marcus did nothing wrong. He built a real product. He had real customers. He worked 18-hour days. But the system that built him up destroyed him just as fast. My name is Ray, and today we're going inside the greatest financial delusion in tech history, the dot-com crash. And I'm going to show you something that most people don't want to admit. It's happening again, right now, in 2026. Segment 2, Ray's Unique Angle. Before we start, I want to say something that most financial documentaries won't tell you. I don't think the people who caused the dot-com crash were evil. I think they were human. Greed is natural. Every single one of us, given the right circumstances, might have done the same thing. The real problem was never the people. The real problem was a system that rewarded insane behavior and punished common sense. A system where lying made you rich, where telling the truth made you look stupid, where the rules were designed to protect the wrong people. That's what we're investigating today. Not just what happened, but why the system let it happen. And why, right now in 2026, nobody seems to have learned anything. Segment 3, The Setup, Internet Gold Rush. To understand the crash, you have to understand the fever. 1995. The internet goes public. Suddenly, every business idea with .com at the end becomes worth millions. No revenue? No problem. No profit? Investors don't care. No actual customers? Just get eyeballs. The logic was simple and completely insane. The internet will change everything. Get in now or get left behind forever. Sound familiar? It should. Because in 2026, just replace internet with AI, and you have the exact same conversation happening right now. Segment 4, The Numbers That Made No Sense. Here are some numbers that will make you question everything. Pets.com, a company that sold pet food online, raised $82 million from investors. Their business model? Sell pet food for less than it cost to ship it. They spent $11.8 million on a single Super Bowl ad. They went bankrupt 9 months after going public. Webb, an online grocery delivery company, raised $800 million. They built 26 massive warehouses across America before they had enough customers to fill one. Gone in 18 months. Cosmo.com promised 1-hour delivery of anything. Books, movies, food, whatever you wanted. They raised $280 million. They delivered items for free with no delivery charge. Let me say that again. They raised $280 million to give you free delivery with no plan to ever charge you for it. This wasn't innovation. This was a room full of very smart people doing very stupid things because the system rewarded them for it. Segment 5. Marcus's story begins. Now let me tell you about Marcus. Marcus Chen was 26 years old in 1998 when he started his company, an online platform connecting freelance designers with businesses. Actually useful, actually needed. Within a year, he had real clients, real revenue, real growth. Then the investors came. And this is where the story gets complicated. Because the investors didn't care about Marcus's real clients or real revenue. They wanted growth. Explosive. Unsustainable. Fake growth. Spend more, hire more, expand faster. We'll worry about profit later. Marcus knew it didn't make sense, but the system told him this is how it works. So he listened. Segment 6. Wall Street feeds the fever. While founders like Marcus were burning cash, Wall Street was making a fortune. Investment banks were taking dot-com companies public at insane valuations, earning massive fees on every IPO. Analysts were publishing glowing reports on companies they privately called dogs. Internal emails from major banks, later revealed in lawsuits, showed analysts calling stocks pieces of junk in private, while publicly telling investors to buy. This is what I mean when I say greed is natural, but the system is broken. These analysts weren't monsters. They were people, working in a system that paid them to lie. If you told the truth, you lost clients. If you lied, you made millions. The system chose for them, and ordinary investors paid the price.
Segment 7. The NASDAQ Peak. March 10th, 2000. The NASDAQ hits 5,048 points, the highest it has ever been in history. Tech stocks are up 400% in 5 years. Everyone, grandmothers, taxi drivers, college students, is investing in dot-com stocks. CNBC is on in every office. Day trading is a legitimate career. Everyone knows someone who made $1 million in the stock market. And then, the Federal Reserve raises interest rates 6 times in 12 months. Suddenly, money is not free anymore. Suddenly, investors ask a question they forgot to ask for 5 years. Wait, does this company actually make money? Segment 8. The crash begins. The answer for most dot-com companies was no. And the market figured it out all at once. March 2000 to October 2002. The NASDAQ falls 78%. $5 trillion in market value. Gone. Not moved somewhere else. Not transferred to another account. Just gone. Pets.com. Dead. Webvan. Dead. Cosmo.com. Dead. Garden.com. Dead. eToys. Dead. Over 900 dot-com companies shut down between 2000 and 2002. 900 companies. Hundreds of thousands of jobs. Billions in ordinary people's retirement savings. And the investors who pushed these companies to spend recklessly? Most of them were fine. They had already taken their fees, already cashed out at the peak. The game was rigged from the beginning. Segment 9. Marcus's company dies. Back to Marcus. March 2001. 1 year after the NASDAQ peak. His investors call a meeting. They tell him the funding is stopping. Not reducing, stopping. Immediately. Marcus has 47 employees. Payroll is due in 2 weeks. He calls every investor he knows, every contact, every connection.
nobody picks up. The same people who were begging to give him money in 1999 won't return his calls in 2001. He sells everything he can: his car, some equipment, his own savings. He manages to give every employee 2 weeks of severance. Then he closes the office. He sits in the empty space where 47 people used to work, and he asks himself one question: what did I do wrong? The answer, Marcus, is nothing. You did nothing wrong. The system failed you. Segment 10. Who actually survived? Here is the most important part of this story that nobody talks about. Not everyone lost in the dot-com crash. Some companies survived. Amazon, Google, eBay, Priceline. And here is what they had in common, something very specific. They had real business models, real revenue, real paths to profitability. Amazon stock fell 90% during the crash, from $113 to $5.51. But Jeff Bezos didn't change the fundamental model. He kept building, kept improving, because the foundation was real. The lesson, if you're listening, is not don't invest in tech. The lesson is real value always survives. Fake value always collapses. It just sometimes takes longer than it should. Segment 11. Ray's opinion, the AI parallel. Now, I want to tell you what I actually think. And I want to be clear, this is my opinion. You can disagree. I respect that. But here is what I see in 2026. Big tech companies are spending $700 billion on AI infrastructure. $700 billion. The Apollo program, putting humans on the moon, cost $300 billion in today's money. We are spending more than twice the cost of going to the moon every single year on AI data centers. And according to MIT research, 95% of companies using AI are getting zero measurable return. Zero. Now, I'm not saying AI isn't real. I'm not saying it won't change the world. The internet was real. It changed everything. But in 2000, the internet was also real, and $5 trillion still vanished. Because real technology and rational investment are two completely different things. People are making the same mistake again, not because they're stupid, because the system, again, is rewarding the wrong behavior. And when it corrects, ordinary people will pay the price. Again. Segment 12. The numbers right now. Let me give you some specific numbers, because I want you to feel this. NVIDIA stock is up 1,300% since 2022. OpenAI is valued at $300 billion. They have never made a profit. An AI startup called Thinking Machines, led by a former OpenAI executive, raised $2 billion. They have no product. They refused to tell investors what they're building. And investors gave them $2 billion anyway. In 1999, Pets.com raised $82 million to sell dog food online. Everyone laughed at them later. In 2026, a company with no product and no plan raises $2 billion. And we call it innovation. History is not just rhyming. History is copy-pasting itself. Segment 13. What you need to know. So what do you actually do with this information? First, don't panic. Panic helps nobody. The dot-com crash was devastating. But the people who stayed calm, stayed invested in real companies, and didn't make emotional decisions they recovered. Amazon investors who held through the 90% crash are worth thousands of times their investment today. Second, ask the question nobody wants to ask. Before you invest in any AI company, any tech company, ask, does this company make money? Not, will it make money someday? Does it make money today, now? Third, watch where the insiders are going. In 2000, dot-com executives were quietly selling their stock at the peak. Watch what AI executives do with their own money. Not what they say, what they do. Fourth, protect your foundation. Emergency fund, diversified investments, no single stock more than 5 to 10% of your portfolio. Real wealth survives crashes. Speculative wealth disappears in them. Segment 14. Marcus today. I want to finish Marcus's story because it doesn't end in that empty office. After the crash, Marcus spent 2 years rebuilding, slowly this time. No venture capital, no explosive growth targets. Just real customers, real revenue, real value. By 2005, his company was profitable. Not worth $40 million on paper, actually profitable. By 2010, he sold it for $8 million. Less than the paper valuation at the peak. More than most dot-com founders ever saw. Marcus told me something I think about a lot. He said, "The crash taught me that paper wealth is just paper. Real wealth is what survives when the paper burns." That's the lesson. Not just from the dot-com crash. From every crash, every bubble, every collapse. Real value survives. Everything else is just timing. Segment 15. The dot-com crash was not a glitch. It was not an accident. It was the predictable result of a system that rewarded hype over substance, speed over sustainability, and paper wealth over real value. And in 2026, I see the same system, running the same play, with different logos. I'm not here to tell you what to do. I'm here to make sure you have information that the people profiting from your ignorance don't want you to have. Because here's the thing about history repeating. It only repeats for people who weren't paying attention the first time. You're paying attention now. That already makes you different. If this investigation opened your eyes, share it with someone who needs to see it. And tell me in the comments, do you think the AI bubble will crash like the dot-com bubble did? I read every comment. I want to know what you think. I'm Ray. Follow the money. And I'll see you in the next investigation.